This is a BC Eagle Intermediate Accounting video. Chapter 12, Equity Investments, Check Figures for a Recent Quiz. Here you have the problem number 2 of the quiz that we had taken, and the purpose of this quiz is to see how well you did on a equity investment. Parent company Kim Company on January 2, 2018 bought 25% of the 1 million shares of subsidiary Phelps Inc. at a price of $10 million. The book value of the net depreciable assets of Kim Company on the date of purchase was $32 million, and the fair value of these same net assets was $36 million. During the year 2018, Phelps Inc. reported net income of $1 million and declared cash dividends of $500,000. At the end of 2018, the fair value of Phelps Inc.'s net depreciable assets was $35 million, and the fair value of parent Kim Company's net depreciable assets was $90 million. We're to make all the necessary journal entries that Kim Company should record for its acquisition of subsidiary Phelps, and then show how Kim Company, parent, should report its investment in subsidiary Phelps on its December 31, 2018 balance sheet, and then, based on the logic that you know of the equity method, show what the subsidiary Phelps owner's equity would be on its balance sheet at December 31, 2018. Now, the logic that we have is that parent Kim bought the equity of Phelps for $10 million, so that is the amount that the parent should record, an increased debit to the investment account and a credit to cash for $10 million. Now, since the fair value of the assets of the Phelps Company was $36 million. We'll show that on the asset side, and the book value, $32 million, we'll show that on the debit side also. Since the parent paid $10 million for 25% of the subsidiary, that implies that the subsidiary's worth is $40 million, $10 million divided by 25%. If the fair value of the assets were only $36 million, we can infer that the difference between what the implied value is and the fair value of the net assets are, that would be a premium paid by the parent. Now, this would be the 100% case for the subsidiary. Accordingly, if the implied value of the total assets would be $40 million, the value of the equity at the beginning of the year on January 2 would be $40 million. The subsidiary earned $1 million of income that we post to owner's equity and paid $500,000 of dividends, which is deducted from equity. Accordingly, $40 million at the beginning of the year plus the income less dividends will produce an owner's equity of $40.5 million at the end of the year. Now, the parent bought 25% of the balance sheet of the subsidiary. So, the parent is interested in the fair value only because that's what the parent paid. 25% of $36 million means that the 25% value of the net assets would be $9 million. And 25% of the implied goodwill, 25% of 4, would give you $1 million for the goodwill. Add the two values together, and you get the $10 million that the parent paid for the subsidiary. By similar logic, if the fair value of all the assets of the subsidiary at the 25% level is equal to $10 million, the owner's equity of the 25% ownership would be $10 million also. 25% of the subsidiary's income would be $250,000, and 25% of the dividends of $500,000 would be $125,000. That would reduce the 25% condition for the owner's equity. So 10 million plus 250 less 125,000 gives the value at 25% of the subsidiary's owner's equity at $10,125,000. The major concept of the investment under the equity method is that the implied fair value of the subsidiary's owner's equity is reflected in the investment account of the parent. So the subsidiary owner's equity shows $250,000 of income. The parent will show that as an increase, $250,000 in the investment account. The sub paid dividends of $125,000 and reduced its owner's equity. Accordingly, the parent would show a reduction of $125,000 for the dividends that it received. Now, in examining the difference between the fair value of the sub's net identifiable assets and the book value of those assets, you can see there is a difference of 36 minus 32, $4 million, of which the parent owns 25%. 4 million times 25% would give us this $1 million difference between the 25% condition fair value and the 25% condition book value. When the subsidiary reports its net income, it reports its net income based on depreciating assets on its book value. The parent, however, paid more than that. Specifically, the parent paid $9 million for 25% of the assets. The subsidiary would have paid only $8 million for those 25% of the assets. So the parent paid $1 million more, which also should be depreciated. If these assets have a 10-year life, that means that 1 million excess paid divided by 10 years should be $100,000 of excess depreciation that would reduce the parent's income. So the sub-income less $1 million of additional depreciation on the excess fair value that the parent paid means that there would be a net income to the parent of $250 less $1 million or $100,000 or $150,000. Less the return of capital, $125,000 of dividends, means that the net increase in the investment account of the parent would be $25,000. So the original $10 million plus $25,000 would give an ending balance of $10,025,000. Now, let's make the journal entries for all of those. We already have the journal entry for the original purchase. Let's make a second entry to record the parent's share of net income. And so increase the investment in Phelps Company by $250,000 and record a credit to investment income of $250,000. Secondly, we'll record the dividends that the sub paid, which reduces the investment account of the parent, credit the investment account of $125,000, and increase the parent's cash of $125,000. And finally, we need to record additional depreciation on the excess value that the parent paid for its 25% share of the assets. So investment income is reduced by $100,000, and the investment in the sub is reduced by $100,000. Because the equity method has a different purpose than a quick turnaround and sale of the investment, equity investments are not adjusted to fair value. Now, let's take a look at the last questions. Calculate what the Kim Company would report its investment on its balance sheet at 12/31. It would show $10 million or $10,025,000. So that would be the amount that would appear in the investment account of the parent. The next question was, what would the owner's equity be of the subsidiary In this case, we want to show the 100% condition because that's what the question asked for. What would the owner's equity of the subsidiary be? Well, it would be the book value of the owner's equity at the beginning of the year, which is $32 million, not the $40 million that the parent paid for those assets. So $32 million book value plus $1 million net income less $500,000 in dividends would give $32,500,000 as what the subsidiary would report in its annual report for its owner's equity at December 31, 2018. There you have it. What the subsidiary shows in its annual report for its owner's equity, what the parent would show in its investment account for its 25% share of the owner's equity, and the journal entries that the parent would make for its 25% share. Thank you for listening.